Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths in company reports and then maybe make fun of them a little bit. Today we are diving deep into Bruce Fund Inc.'s latest annual shareholder report, and let's just say this report is a bit of a mixed bag, like finding a great stock tip on a day the market crashes. We're looking at the Bruce Fund Inc.'s annual report for the period ending June 30, 2025. Bruce Fund Inc. is a registered investment company, basically a mutual fund. Their goal is long-term growth. Now this is where things get interesting. The Bruce Fund shares saw a gain of 79% for the year. That sounds pretty good, right? Well, the S&P 500 index during the same time jumped a much more impressive 15-16. So while the fund grew your money, it did so much slower than the overall market. The report explains this by saying the fund's more cautious approach lagged behind the market's rebound. Think of it like this: if the market was a race car, Bruce Fund was more like a reliable sedan that didn't quite reach the finish line as fast. Looking at the long game, we can see a trend here. Over the last 10 years, the Bruce Fund has consistently underperformed the S&P 500. For example, way back in June 2015, if you had invested $10,000 in the Bruce Fund by June 2056, that's a massive difference and really highlights how a more conservative R93 Ravan by if you had put that same 110 and 990, that's a decent return. But if you had put that same 110 really 9 of a whopping 3050 1936 and P500, you would now have a whopping 3090 1569,000, a massive difference, and really highlights how a more conservative strategy can miss out on significant market gains. Let's look at the average annual returns. For the last year, Bruce Fund returned 79%, while the S&P 500 had 15.46%. Over 5 years, Bruce Fund averaged 6.36%. Over 5 years, Bruce Fund averaged 16.364%. And over 10 years, Bruce Fund averaged 5.99%, while the S&P 500 averaged a solid 13.65%. These numbers paint a clear picture. Bruce Fund has struggled to keep pace with the broader market for quite some time. Financially, the fund manages a substantial 345 to 516 587 in assets. That's a lot of money. They hold 43 different investments, and their advisory fee is over $1.6 million. The portfolio turnover is pretty low at 11%, which means they aren't actively buying and selling stocks very often. This aligns with their described cautious approach. Now let's see what they're actually invested in. Common stocks make up the bulk of their investments at 82%. They also hold money market funds at 13.7% and some US government and agency investments at 4.1%. There's a very small piece, zero, primarily a stock-focused fund with a decent chunk in cash-like instruments. Digging into the sectors, we see healthcare makes up 20.1% and utilities another 21.2%. Financials is next at 12.6% and industrials at 11.11%. This mix suggests a focus on more stable defensive sectors like healthcare and utilities, which again points to that cautious investment strategy. Looking at their actual holdings, the largest position by far is Morgan Stanley Institutional Liquidity Government Portfolio at 13.7%, which is a money market fund. Then we see familiar names like Allstate Corp, the at 6.5%, AerCap Holdings NV at 6.1%, and U-Haul Holding Co. Class B also at 6.1%. The rest of the top 10 are companies like Duke Energy, NextEra Energy, AbbVie Inc., Abbott Laboratories, AT&T Inc., and Merck Co. Inc. This confirms the heavy weighting towards defensive and established companies. Let's dive into the actual financial statements. The schedule of investments shows their common stocks. AT&T Inc., for instance, is held with 6,000 shares valued at over $17 million. They also hold a significant amount of Abbott Laboratories and AbbVie Inc., indicating a strong belief in the healthcare sector. The utilities sector is also heavily represented with Duke Energy Corp. And NextEra Energy Inc. among their top holdings. In terms of operations for the year ended June 30th, 2025, the fund generated over $11.5 million in investment income, primarily from dividends. But their expenses were also significant, totaling almost $2.3 million. The investment advisory fees alone were over $1.6 million. After expenses, they had a net investment income of over $9.2 million. Then there's the change in unrealized appreciation. This is essentially how much the value of their investments went up or down without being sold during the year. For Bruce Fund, this was a gain of nearly $7 million. Coupled with their net realized gains of over $12.7 million, their total net gain on investments was nearly $20 million. This resulted in a substantial increase in net assets from operations of almost $29 million. This resulted in a substantial increase in net assets from operations of almost $29 million. This resulted in a substantial increase in net assets from operations of almost $29 million. This resulted in a substantial increase in net assets from operations of almost $29 million. This resulted in a substantial increase in net assets from operations of almost $29 million. Looking at the statement of changes in net assets, we can see that the fund experienced a net decrease in assets by over $57 million during the year. This was mainly due to share redemptions where investors cashed out about $88.6 million worth of shares. Even with the gains from operations nearly $29 million and reinvested distributions over $16 million, the outflows were simply larger. Let's check out the financial highlights. For the year ending June 30th, 2025, the net asset value per share ended up at 517.82 cents. This is up from 504.76 at the start of the year. The total return for the year was 7.79%, as we saw earlier. The expense ratio is 0.61%, which is what investors pay as a percentage of their investment to manage the fund. That's a pretty standard fee, but considering the performance, it might seem a little high to some. We've also got the detailed breakdown of their investments. You can see individual company names like Archer Daniels Midland Co. and Bunge Global SA in consumer staples. In the healthcare sector, they hold a lot of stocks, including Eli Lilly and Co., which is a big name. It's good to see they have quite a diversified portfolio across different industries. Notice how they have a few securities marked with these are non-income producing securities, which means they don't pay dividends or interest. They also have some securities marked with these are non-income producing securities, which means they don't pay dividends or interest. They also have some securities marked with which are illiquid, meaning they're harder to sell quickly. One notable change mentioned is that in December 2024, Grant Thornton LL resigned as their independent auditor. Cohen and Company Limited has been appointed to take over. They state there were no disagreements with the previous auditor, which is usually a good sign. It's also important to note that the fund does not engage in securities lending. This is a way for funds to earn extra income, but it also comes with risks. By not doing it, Bruce Fund is likely opting for a simpler and perhaps safer approach. The independent auditors, Cohen and Company Limited, have given their stamp of approval on the financial statements. They state the financial statements present fairly the fund's position and performance. They've been auditing the fund since 2025, which is the start of this reporting period, so it's a relatively new relationship. So what's the big picture here? Bruce Fund Inc. seems to be taking a very cautious approach to investing. They are heavily invested in stable sectors and hold a significant amount of cash. While this strategy has protected them from the worst market downturns, it has also led to them significantly underperforming the broader market over the last decade. For investors seeking aggressive growth, this fund might not be the best fit. However, if you prioritize capital preservation and a steady, if slower approach, Bruce Fund might align with your goals. The big question is whether their current strategy will pay off in the long run or if they'll continue to lag behind the market. Their heavy allocation to money market funds could be seen as a sign of their wariness about current market valuations, a sentiment that's echoed in their commentary about debt levels and potential economic slowdowns. What's your take on these numbers and what they signal for the company's future? Do you think Bruce Fund's cautious strategy is the right move in today's market? Drop your thoughts in the comments below. If you found value in this breakdown, hitting that like button really helps us out, and subscribe for more deep dives into corporate financial reports. Don't forget to check out our Discord community, linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.